In 1998, a man wrote a $100,000 check to a company that didn't exist yet. He'd watched two students demo their idea for a few minutes. He was late to work and he wrote the check on the spot. The company was Google. The man was Andy Bechtolsheim, a co-founder of Sun Microsystems, and he wrote that check from his own bank account. The two students hadn't even started the company yet, so for a while they couldn't deposit the money because there was nowhere to put it. That one check later became worth over $1 billion. One person betting their money on a founder before anyone else will. That's what's called an angel investor, and it's one of 6 completely different kinds of people who fund startups. Most founders lump them all together under 2 words, venture capital, but they show up at different times, they write very different sized checks, and every single one of them wants something different back. The money even behaves differently the day it shows up in your account. But the kind of investor you take money from can matter more than the money itself. If you take the right amount from the wrong kind, it can destroy a company that was working just fine. An angel investor is the simplest kind, and usually the first money a company ever takes. It's one person writing a check from their own bank account, the same kind of check Bechtolsheim wrote to Google. Usually that's a friend, someone who has built a company before, or a wealthy person who got excited about you or the idea. They tend to put in somewhere between $25,000 and $250,000, and sometimes up to $500,000 if they're well off and fully convinced. In return, they take a small slice, usually 1 to 5%, because there's no funds sitting behind them. There's no pressure to make you worth more by next quarter. What they're paying for is the chance to be early on something that works, so the return matters to them a little less than it would to a big firm. An accelerator runs a program you have to apply to get into. They give you a set check in exchange for a slice of your company, place you in a group alongside other startups, and build toward a demo day at the end. The usual deal is about $100,000 to $150,000 for 6 to 10% of the company, though a few go higher. Y Combinator, for example, puts in $500,000 in total, and some programs go up toward $1 million. What they're after is a reputation for spotting winners early, along with a steady run of strong demo day stories that pull in the next group of founders. A seed fund is usually the first big piece of professional money, an actual fund whose entire job is investing money on behalf of other people. They write checks of $500,000 to $3 million, and they aim to own somewhere around 10 to 20% of the company. Their thinking is to own enough at a low enough price that when you raise your next round at a higher valuation, their slice is suddenly worth 2 or 3 times more on paper. That jump on paper is what helps them go and raise their own next fund. So they need you to grow, and grow quickly. A big VC is the later, larger fund. They write much bigger checks, anywhere from $5 to $20 million and up, but they aim for a smaller percentage because by that point, the company is worth far more. They're hunting for 1 or 2 companies and their entire stack of bets that can pay back the whole fund on their own. Most of their bets lose money, so the entire model depends on finding that rare, giant winner. They pour more money in when a company is working, and they pull back quickly when it stops. A strategic investor is a large corporation, or the investing arm of one. The money comes straight off the corporation's own books, and they're looking for something beyond a return. They want your technology, your customers, the data you've collected, or simply to keep you out of a competitor's hands. Plenty of large platforms run an arm like this, investing in smaller companies to pull them deeper into their ecosystem. A family office is usually the investing arm of a single wealthy family, putting the family's own money to work. Some of them are looking for a slow, steady growth over 10 or 20 years. Others back you because they liked the idea over dinner, or because you remind them of their own kid. Since there's no fund clock forcing them to cash out on a schedule, they can afford to wait in a way no ordinary fund ever could. So when you boil those 6 down, they sort into 4 kinds of money. Angels and family offices are personal money, one person's or one family's own cash. Accelerators are a program you pass through. Seed funds and big VCs are professional funds with strict math behind every move they make. And a strategic investor is a corporation with its own plans for you. The whole trick is matching the kind of money to your own timeline and to the kind of business you're building. Most first-time founders skip all of that and simply chase the biggest name. But knowing what each one is only gets you so far, because the friendly version they pitch you hides what they're after underneath. And that is where founders can get in trouble if they're not careful. Each of these investors is chasing a different payoff, and that payoff decides how they'll treat you once the money is in. An angel investor is betting on you. They write a personal check because they believe in the founder or because the idea got them excited, and they want to be able to say they were early on something that worked. It's their own money on the line, so for them, the decision is personal. An accelerator is betting on how things look. Beneath the "We're here to help founders" pitch, what they need is a run of strong demo day stories, because that's what keeps the next group of founders applying and keeps their name growing. They take that cheap 6 to 10% early so you look smart later, once you raise your seed round at a higher price. A seed fund is betting on the next increase in price. They need your following round to value their shares higher, because that jump in value is what lets them go on and raise their own next fund. The people who handed them the money to invest are the ones they answer to. So if you don't grow fast enough to pull in bigger checks behind them, they get nervous quickly. A big VC is betting on the one big winner. One or two enormous outcomes pay for all the bets that they lose. So the whole fund is built to chase that rare home run. The moment your growth flattens out, their patience starts to drop, because the people funding them are always watching the returns. A strategic investor is betting on their own business. They want your technology, your customers, or to keep you out of a competitor's reach. And the check usually arrives with expectations about helping their product or working together down the line. A family office is the hardest one to read. Some treat it as patient money meant to compound slowly over years. Others treat it like a personal bet, which means the decisions can turn emotional. Either way, the reason behind the check is usually personal, or about leaving something behind for the family. This is why the same pitch that makes one of these investors lean in makes the next one stop replying. They simply aren't buying the same thing. Your job is to match the investor whose reason lines up with how your company needs to grow, or you'll spend the next 1.5 to 3 years fighting over goals that were never going to fit. And once one of them does commit, the difference between them shows up somewhere you can see it plainly, right there in the bank account. The kind of investor you take money from changes how the money shows up. The size of the wire, how fast it clears, where it comes from, and how many strings come attached all shift depending on who sent it. Angel money comes straight out of a personal account, and the amount is usually somewhere between $25,000 and $250,000. The timing is the part you can't predict. Some of it hits the same week they say yes, while some drags on for 2 or 3 weeks as they move the money around. The paperwork stays light, and when it arrives, it's clean. There's no board seat and far fewer strings than the big fund money carries, so it's usually just a wire and you're done. Accelerator money shows up on a set schedule, once you've signed their standard agreement and started the program. It comes from the accelerator's own company, so you know the exact amount and the timing before you ever begin. It's clean on the money side, though the slice of your company is locked in early, and the paperwork is one size fits all and written to favor them. Big fund money, whether it's from a seed fund or a later one, shows up only after a formal closing. It arrives as a wire from the fund's own company, under the fund's name. A seed check often runs $500,000 to a few $1,000,000, and a later check jumps to 5, 10, even 20 million and up. It usually arrives in 1 or 2 pieces, once every signature has been collected, often 3 to 8 weeks after you've shaken hands on the deal. It brings far more paperwork and sometimes a seat at the table watching how the company gets run. Strategic money can look like an ordinary fund wire, but it tends to arrive alongside side agreements or expectations about working together that surface right around the time the cash does. The timing usually slips as well, because a large corporation has to approve the deal through its own internal channels first. Family office money behaves like a big angel check, except it comes from the family's company rather than one person's account. The amount can be large. The timing depends entirely on when the one person in charge signs off, and it can be slow even after they've already said yes. So what you feel at the bank comes down to 3 things: how predictable the money is, how fast it arrives, and how simple it is to take. Accelerator money is the most predictable. Angel and family office money can be the fastest and cleanest, though you can't always count on the timing. The big professional money is the slowest to come through, but it carries the most weight for your next round. As a rule, the simpler the paperwork, the fewer strings travel along with the wire. The kind of investor even shapes how founders spend the money in the first 90 days. Angel money tends to loosen people up because nobody's checking the weekly numbers. Accelerator money gets poured into looking impressive for demo day. The big professional money comes with the most structure, but also the most pressure to spend it quickly, so you can raise the next round on time. The thing to remember is that the money is never neutral once it's in your account. The investor's reasons travel along with every dollar you spend, which is exactly why you want to see every one of those dollars clearly from the very first day. Qualifying startups can apply for free Delaware incorporation right inside Row in a few minutes without ever leaving the application. It's attorney reviewed, and banking and cards are live as soon as you're set up, even before your EIN. So the company starts its life with clean books and one place to watch every dollar, instead of a cleanup job later. Links in the description if you want to check it out. Getting the money in is the easy part. For 3 of these 6, the bigger cost doesn't show up until much later. 3 of them, the accelerator, the strategic investor, and the family office, hand you a bill that doesn't come due until long after the wire clears. With an accelerator, the cash itself is the clean part. You gave up 6 to 10% of your company for a small check, and you did it at one of the cheapest prices in the company's history. Every future round stacks on top of that early deal, so later investors set their price against it, and the slice you handed over early ends up costing you far more than it looked at the time. There's also a cost to your time. You've got a public demo day clock ticking, so weeks disappear into the introductions that may not fit you, into tweaking your pitch towards whatever the accelerator wants to show off, and into network events instead of customer calls. The thing founders miss is the timing of the price. By the time they raise their seed, that big early slice makes new investors set their number against it, and the founders can hand over more of the company than they plan to. So go in clear-eyed. An accelerator can be worth it for the network and the credibility, but the equity you give up early is some of the most expensive in the company's life. Strategic money is the one founders read wrong the most. It feels powerful at signing because the corporation pays a fair price and brings serious weight behind the deal. Then the conversation about your product starts, and they push for features that help their own product but slow down yours. Your sales start taking longer because deals need their blessing first. And the worst part shows up at the very end, when you try to sell the company. A strategic investor can hold up the vote for months, drag their feet on approvals, then jump in at the last second, match a clean buyer's offer, and take the company themselves at a lower price. You still get paid, but you lose the bigger number a normal buyer would have left on the table. The trap is any term that gives a strategic investor the right to block a sale or match an offer. It looks harmless on the page, and it gets very expensive the moment a serious buyer shows up. Family office money is the last one. It feels patient and founder-friendly at the start. There's one person to deal with, less paperwork, and warm promises about putting in more later. Then that one person gets distracted. A shiny new deal shows up, or something happens in the family, and a year and a half later your runway, the number of months cash you have left, is getting thin while they go quiet on that next check. There's no committee and no process behind them, just one person who stopped answering. A normal fund is more likely to have your money set aside for you, or to tell you no early enough that you could fix it. Instead, you're scrambling for a short-term loan at a bad price, and because they treat the check like a personal bet, when things get bumpy, they can get emotional and push for a quick sale or a change at the top that a professional fund would never force that early. The thread through all three is the same. The money that feels the cheapest and easiest the day you sign is often the one that costs you the most the day you go to sell the company or raise again. And the costliest mistake of all is taking the right amount of money from the wrong kind of investor. It's one of the most common ways a good company falls apart from the inside. The investor is solid, the founder is solid, and the money is still wrong for the business. Picture a startup that builds specialized equipment for factories, the kind of physical hardware you manufacture and ship. They had solid early traction and working trial installs, but they needed patient money because building a physical product and sorting out manufacturing takes time. They raised their first big round from a well-known software fund that loved the founder and loved how big the market could be. But there was a problem. That fund's whole world was software. They were used to companies with monthly subscriptions, fast growth, and the kind of numbers that make a software bet look good to their own investors. So they started pushing this hardware company to act like a software company. They asked for dashboards and subscription plans that didn't fit a business that sells a physical machine once. The founder started spending weeks each month building reports, trying to force monthly revenue onto a product that didn't work that way. Spending climbed as the team chased the wrong goals. Manufacturing fell further behind as the founder's attention split in two. By the time they needed their next round, the story looked like a mess to everyone else. The first fund didn't want to lead again, and new investors passed because the numbers didn't fit the only model that the fund knew how to judge. The company folded, trying to be something it was never built to be. Fund money is never neutral. Every check comes with an expected path baked into it, and when your business sits off that path, the pressure keeps building, and it slowly bends the company toward the wrong shape until it breaks. So when you've got two offers on the table, how do you pick the one that won't do that? Start by writing down what you need over the next 1.5 to 2 years. Then pick the investor whose reasons line up with that. A lot of it comes down to where you are. When you're early and still proving the thing works, angels and accelerators are the natural fit. Once you've got enough going to chase that serious next round, that's seed fund territory. Big VCs make sense when the company can grow fast enough to become huge. A strategic investor is worth it when the partnership helps you more than it boxes you in. And a family office fits when you need patient money and can handle a slower, less predictable process. A famous fund fund brings a name. It helps you hire, it gets you in front of big customers, and it makes your next round easier to raise. The cost is that the fund has its own plan and its own clock. Partners come and go, and the push to hit certain numbers or to raise again on schedule can run right over what your business needs. A quieter investor who fits you better usually means they understand your business more deeply. They get your model. They can stay calm through a slow stretch or a change in direction. And they might roll up their sleeves and help instead of just making introductions. The trade-off is a smaller name on your announcement and sometimes slower money when you need more. It can go either way, honestly. One company took the famous fund even though a smaller, more hands-on investor fit their hardware business better. The big name helped them close key hires and get in front of big customers. And the brand carried them all the way to a good sale, even with all the pressure that came with it. Another team, a software company, had a famous fund offering money and a quieter investor who'd built companies like theirs before. They went with the quieter one. When their numbers dipped after a change in direction, that investor stayed in, helped them fix how they were selling, and wrote another check at the same price when they needed it. The company steadied and later raised a much bigger round. So the right call is whichever investor's reasons match where your company is right now. The famous name on the slide counts for a lot less than founders think. A famous fund can be worth the pressure when speed and a big name are the things you're short on. What most first-time founders do is grab the biggest name on reflex and only find out much later whether that pressure helped them or hurt them. So look, the check is the easy part. The person behind it shapes the next few years of your company, sometimes more than the money does. An angel, an accelerator, a seed fund, a big VC, a strategic investor, and a family office will each pull your company in a different direction because each one wants something different back. Before you cash anyone's check, get clear on what they're after and whether it matches where you're trying to go. And the best way to walk into any of those conversations is with your own numbers already in order. So if you're building toward a raise, qualifying startups can apply for Delaware Incorporation right inside Row. Attorney reviewed with banking and cards live as soon as you're approved. Links in the description. Once you've picked the right investor, the next thing that shapes how this goes is what you sign. That's where the dilution, the terms, and who controls the company once the money's in all get decided. That's the whole subject of the next video to watch. See you there.